Hey, welcome back to the channel. My name is Jesse, and today we're going to be going over Google. As always, check out the description. I've got a timeline of the content, so if you want to skip forward to certain content, feel free to do so. All right, so first let's go through a brief overview of the company. As you can see, this is it. We got Google. That's all there is to know. That's it, right? Yeah. Okay, let's go on. All right, just kidding. I tried to find an investor presentation. I couldn't find one. I don't know if I'm blind or what, but let's just go over kind of their revenue streams first. Here we got different business segments for Google. We can see it's mostly advertising through Google Network, Google Search, and YouTube ads. We have some other services which are going to probably equal like Android, things like that. We have Google Cloud, which is their cloud offering, and then we have other bets, which are their small ventures, and then hedging gains or losses. Most likely, I'm wondering if they're hedging for currency risk across the revenues. But yeah, that's kind of a brief overview of the different segments. And then if we look at where that revenue comes from, over 50% of their revenue comes outside of the United States. So they're pretty heavily diversified to international regions when it comes to their revenue streams. We've got about 32, I believe that's in millions, so that'd be 32 billion, 32.7 billion from the United States in revenues, and total revenues 69.6 billion. If you're doing a constant currency revenues would be 71.9 billion. So really nice diversification of their revenue streams across different areas. And with that, let's get into the 5-year chart. Okay, so we can see that Google has had a great run over the last 5 years, starting out at about 45 bucks, 50 bucks, topping out at 150. Then coming back down, briefly hit 100. It's been chopping around a little bit and started uptrending towards 122 currently. So, and we can see during the COVID crash, they're at around 75, 77, went down about 50, 52 before just ripping. And it's kind of a cool chart because it seems like drastic increase, especially on the 10-year basis as well. But as we get into the fundamentals, you'll kind of see the revenue net income increase right along with it. It doesn't make it seem that ridiculous when you see the type of revenue growth and the type of bottom line growth that they have produced over the last 5-10 years. So let's jump on into that. All right, and then this is what I was talking about. Look at that beautiful revenue growth and bottom line growth over the last 10 years for Google. It's been amazing. If we go over to the income statement, we can see kind of the quarterly breakdown. Just been a tremendous performer. A little bit of a dip with the going through COVID, but recovered and pushed to all-time highs regarding the business fundamentals of revenue and generating income and bottom line income. So just amazing performer over the last 10 years. Let's go over some different metrics and whatnot. So I'm a little excited about this sheet because I started messing around with some different API services and I got it fully automated. So check this out. Dun, dun, dun. Boom. Everything updates. Isn't that cool? I'm just gonna, that's pretty sweet. I'm loving it. Saves me so much time. I'm plucking all the key metrics I want. Yeah. And okay, that's a little side note. So we'll go back. I am probably going to do a video on the API that I'm using. So if you want to see that, make sure to like and subscribe. And hopefully I'm going to get that in the next week. Probably get that out. So, and I'm probably going to make a template available in this type of form so you can integrate the API and do something similar and then come up with your own evaluation sheets if you want. But you can integrate the input of the raw data. So stay tuned for that. But let's get back to it. So we can see for Google, we've had steady revenue growth on a 5-year basis. Bottom line growth has been 31%. It's had an average dilution of about actually buying back 0.74% per year in shares. From a valuation standpoint, the average EBIT yield spread has been 2.17. The average net yield spread has been 1.62. The average free cash flow yield spread has been about 1.79. All right, so if we get into the revenue, we have about 18.3% revenue growth over the last 5 years, 17% gross profit growth, operating income growth over the last 5 years of 24%, EBIT growth over the last 5 years of 27.25, net income growth of 43.12, free cash flow growth of 22.89, ROA of 13.17, ROE 18.19, ROC 17, quick ratio 3.55, current ratio 3.69, cash ratio 0.43, buybacks average of about 0.74. You can see solid top line and bottom line growth across all metrics. Gross margins going from about 60% down to probably around 58% or so, 56%. Bottom line margins staying kind of in that 20 to 28% range over the last 10 years with a little bit of fluctuations here and there. Kind of see the kind of deviation in spread between the bottom line yields and the risk-free rate over the last 10 years. The return on assets, equity, capital metrics, fully diluted shares outstanding, and these charts are all on a yearly basis. Historic growth rates, can kind of see that mapped out. Then short-term quick ratio, current ratio, cash ratio. Let's jump into the income statement. All right, so income statement. This is just going to be kind of more detailed, at least in the on a quarterly basis that I have for the last 10 years. And I also break down some of these research and development, like kind of different expenses and whatnot that I'm interested in. So cost of revenue, operating expenses, interest expenses, things like that. So we can see like steady growth, but also, you know, we've had amazing bottom line and top line growth. So the margins have been kind of staying in check while the company grows. You can see the kind of shares kind of topped out from diluting and now going into buybacks over the last several years. EPS diluted on a per share basis has seen nice steady growth, with the only negative coming in 2017 briefly. Last several years, we've seen really good EPS growth on a per share basis. If we jump into the balance sheet, so total current assets to total current liabilities and cash and short-term investments. We can see they've got a lot of cash on hand, and they have probably 2x the amount of cash on hand as their current liabilities. So that's really good, 2 or 3x. So total current assets to total current liabilities is really solid. Total assets, total liabilities, same story. Just overall looks really, really good. Goodwill and intangible assets, we can kind of see the growth here over goodwill, but we also had shrinking intangible assets. So kind of probably if we stack these, it'd probably kind of like even out. But in all things considered for the size of the company and the revenue that they're doing, this is not that much. Here we can kind of see property, plant, equipment, capital lease, total liabilities, stockholder equity, just steady growth throughout. So kind of keeping their expenses, lease obligations in check while they're growing. But we don't see any drastic spikes or anything like that would be cause of concern. If we go to the free cash flow statement, you can see operating cash flow continue to steadily grow. We have depreciation and amortization starting to continue to rise as they spend more on CapEx and investments in property, plant, and equipment. So as that rises, their depreciation and amortization in the future years is going to rise because they will be depreciating that out. Let me know if I'm wrong there, but I don't think I am. Free cash flow has been a steady grower. Net changing cash has been pretty pretty low, maybe a little bit negative, and then we can kind of see where that cash flow is going based off of this chart where we see debt repayment, common stock issued, common stock repurchased, and dividends paid, right? So different companies are going to allocate capital differently. Here we can see that they've been doing a lot of debt repayment and a lot of common stock purchases. So lowering their debt and then returning value to shareholders by buying back stock and lowering the float of the company. Ratios and metrics. Here we get a little bit longer term view of the 10 years on a quarterly basis for different margins. A little bit of fluctuations, but fairly steady all in all. Per share metrics, which is kind of cool. You can just see the shareholders equity per share, cash per share, capex per share, free cash flow per share, operating cash flow per share, net income per share. And we kind of the same story. We've just seen a constant grind up, keeping in check with the overall business growth. And if I wanted to, let's say I wanted to just look at free cash flow per share, since that's kind of getting drowned out, what you can do, you can go data range on these charts, go to these series, and we're just gonna could remove these. All right, so if we do that, we can kind of select the specific data that we want to see, and we get a nice graph of net income per share, operating cash flow per share, and free cash flow per share over the last 10 years on a quarterly basis. So pretty cool how easy it is to edit these charts and grab the specific data that you want. Valuation metrics, we're looking at PE ratio, price to operating cash flow ratio, enterprise value over EBITDA, and EV to free cash flow. So we can kind of see valuation wise, even though the stock has been on a tear and it's been going up and up and up and up, seems like forever for the last 10 years, the valuations have kind of remained consistent. They've chopped around a little bit here and there, but we don't see that a constant decrease or increase that would indicate multiple expansion or contraction. We can see the same exact thing with the yield metrics too. So on a yield metric basis, we've kind of just been, right between this 0.5 to 1.5 range for a pretty long time on a quarterly basis for the free cash flow yield and the earnings yield. Dividend payouts, Google doesn't have dividends right now, so that's going to be empty. And I'll kind of show you briefly, give me a second, I'll show you a different company where we can see that a lot of the price increase was due to multiple expansion because we had a slow decrease in the yield metrics. So it was yielding more, means the value was more. And then we can see the same inverse with the valuation metrics over here, looking at the PE ratio, enterprise value over EBITDA, EV to operation cash flow, and EV to free cash flow. So give me a second, I'll pull that up. All right, I have the wrong ticker in there. 1 second. All right, there we go. So got all that data loaded, but go back to ratios and metrics, and we can see, as I was saying, Apple not only experienced really good share price appreciation from bottom line fundamentals over the last 10 years, but they've also experienced a decent amount of multiple expansion. You can see that the PE ratio, enterprise value over EBITDA, EV to operation cash flow, and EV to free cash flow, those have steadily increased over the previous 10 years, which means they are basically having a higher multiple, higher premium on Apple. And we can see that the free cash flow yield and earnings yield has come down when compared to the overall basis. So if you're buying back here, you were probably yielding about 2 to 3% on your investment to the bottom line of free cash flow and earnings, whereas now you're only getting about 1%. So we had pretty good multiple expansion over the last 10 years for Apple, which gave it even more of a tailwind on the equity price to kind of just rip over the last 10 years. And we can see, there we go, that chart updated. We see the historical dividends as well. So that is that. And let's get back over to Google. All right, so here we go. Let's go over the valuation side, kind of my metrics, what I'm looking at. First off, I've got a margin of safety 5%, base KGAR of 15% that I'm targeting. So I'm trying to get about 15%, margin of safety 5%. So 20% is going to be kind of my go on these different cases. We can see over the last 5 years, risk-free rate has been about, which 10-year treasury has been about 1.99%. Dilution has been actually buybacks of about 0.74%. Bottom line growth has been 31.09% across the different bottom line metrics that I track. EBIT yield spread has been 2.17. Net yield spread has been 1.62. Free cash flow yield spread has been 1.79. The adjustments that I'm making, these adjustments basically adjust for the very bullish case, and then I kind of do a percentage of the very bullish case for my other bullish, base, bearish, and very bearish cases. So in this case, we're doing an adjustment of an additional 0.5% in buybacks for the very bullish case. We're doing an adjustment of decreasing bottom line growth by 5% for the bullish case, and we're going to leave the yield spreads equal. We're going to say that's about fair for a bullish scenario. All right, so on the very bearish case, we have the risk-free rate going from 4.87% down to 1.99% in the very bullish case. Dilution, we have buybacks of 0.65% in the very bearish scenario and 1.24% in the very bullish scenario. Bottom line growth in the very bearish scenario, we got 13.62% going to 26.09% in the very bullish scenario. Future estimated EBIT yield spread. Very bearish scenario, we've got 4.17. Very bullish scenario, we got 2.17. Net yield spread, we got 3.62 in the very bearish scenario, going to 1.62 in the very bullish scenario. Free cash flow yield spread, we have 3.79 in the very bearish scenario and going to 1.79 in the very bullish scenario. What that gives us is a 2026 estimated price target range between $131.67 for the very bearish scenario and a very bullish scenario of $517.04 off of these estimations if they were to come true. At this price, we would be meeting my targeted 20% KGAR through the bullish scenario. The base case wouldn't be quite there yet. We'd be at about 14.84% KGAR off of the base case right now. And we'd be all the way down at 7.7% for the bearish case and 1.52% for the very bearish case. So to really get that base case into the green, I'm probably gonna have to see a price of around $100. Yeah, what, 98, something like that. Yeah, right at 98 is kind of where we saw it. So if we go back to the chart, we see that we had massive buying pressure also right around that time, or right around that price point. So, but that's also a combination of macro factors that were going on at the time. So for the base case, 110, 108 gets us pretty close. And I'm pretty inclined to try to maybe jump on it a little bit earlier because I personally would love to have it as a bigger percentage of my portfolio or my individual stock portfolio. So it's definitely one that I would love to build out if I got the opportunity. So about 100 or so for the base case to get 20% through. For the bearish case to get 20% through, it's going to have to drop a lot. We're probably talking like $85. No, more than that, 80. Man. Yeah, it would be pretty drastic. Honestly, I don't really see that happening. It would be, what, 75? Yeah, $75 a share or so. But, it's possible. I could obviously adjust these bearish and very bearish cases. But I kind of like to, I'd like to stay consistent. I could probably bring the spread in a little bit though. depending on my comfort with the business and my knowledge on the business, and how comfortable I am with believing that the spreads between the very bearish scenario and the very bullish scenario are going to be pretty tight. All right, well, that's about all I got. I hope you enjoyed the video. If you did, please give me a like, and feel free to subscribe. I'll be trying to come out with a video going over the API that I'm using and integrating it into Google Sheets, and possibly releasing a Google Sheet template on my Discord. So feel free to check out the Discord. It's free Discord, of course. Never gonna charge for anything. Yeah, hope you got some good information out of this. Have a great day, and we'll catch you later.